What if I told you there's a little-known Asian supply chain powerhouse with zero debt, strong net cash, 3 straight years of record profit, and a forward PE of just 4.5? Yet almost nobody is talking about it. This is Leverstyle 1346.HK, an apparel supply chain company that quietly outperforms its industry, serves over 150 global brands, and is transforming itself into a tech-enabled, asset-light platform with ROE above 30%. In today's video, we uncover why this overlooked stock might be one of the most undervalued plays of 2025, and whether the market has completely mispriced its growth potential. Leverstyle began as a premium apparel manufacturer built around a very simple idea. Instead of owning expensive factories, the company would focus on design support, sourcing, quality control, and managing a flexible network of production partners. In its early days, the company made a name for itself by supplying high-end fashion houses, winning orders because of its craftsmanship and strict quality standards. Over time, Leverstyle realized that the apparel industry was changing. Brands wanted smaller batches, faster turnaround, and more customized designs. Traditional factory-heavy manufacturers struggled with this shift, but Lever's asset-light model allowed it to scale quickly without heavy capital investment. By working with a growing network of partner factories rather than owning them, Leverstyle could move production between countries, match each brand to the right factory, and grow without taking on debt. This early strategic choice became the foundation of its long-term advantage. As e-commerce brands started booming, Leverstyle was one of the first apparel suppliers to pivot toward digitally native brands. These fast-growing online labels needed flexible manufacturing, rapid design iteration, and low minimum order quantities, exactly what Lever's model offered. This is how the company evolved from a premium apparel supplier into a multi-category, multi-country supply chain orchestrator, eventually serving more than 150 global brands and positioning itself as a future digital platform for apparel sourcing. Leverstyle's business is built around 3 major customer groups. First, digitally native brands, which make up about 45% of revenue. This includes fast-growing online fashion labels that rely on Leverstyle for speed, flexibility, and small batch production. This segment also tends to carry higher margins because digital brands value agility more than price alone. Next, premium brands at around 40%. These are well-established apparel names where Lever provides high-quality sourcing, technical design support, and multi-country production. This segment grew strongly after the company acquired several businesses and expanded into premium product categories. Finally, conventional and modern brands contribute roughly 15% of revenue. They bring steady, recurring orders and form the company's stable volume base. Together, these 3 customer types show that Leverstyle is not just a garment manufacturer. It's a diversified, multi-client supply chain platform with exposure across fast-growing digital labels and long-established premium brands. Now, let's break down where the money actually comes from. The United States is by far the company's largest market, contributing about 58% of revenue, roughly $129.9 million. This reflects Leverstyle's strong relationships with North American fashion brands and digitally native labels. Europe comes next at around 25% or $55 million. This region is primarily driven by premium and technical apparel clients. Oceania, mainly Australia and New Zealand, contributes 15% or about $34.6 million. Greater China, which includes mainland China, Hong Kong, Macau, and Taiwan, makes up just under 1% or $1.4 million. And the remaining 0.9%, about $2 million, comes from other markets worldwide. So overall, Leverstyle generates most of its revenue from the US and Europe, while serving a mix of digital, premium, and conventional brands. This combination gives the company both stability from traditional clients and growth potential from fast-scaling digital brands. With that foundation in mind, let's move to the next part of the analysis. Let's break down Leverstyle's financial performance across the last 6 years, and you'll see why this company stands out in the apparel supply chain space. Starting with the top line, revenue has grown strongly from about $88 million in 2020, during the height of COVID, to more than $222 million in 2024. That a recovery of over 150% in just 4 years. Net profit has followed the same trajectory. From almost break-even in 2020, profit surged to $14.5 million in 2022, then $15.6 million in 2023, and reached $17.1 million in 2024, giving Leverstyle 3 consecutive years of record profitability. What's impressive is not just the revenue, but the margins. Net profit margin has expanded from nearly 0 in 2020 to around 7 to 8% in the last 2 years. For an apparel sourcing platform, that's a very strong margin profile. Operating efficiency also shows up in the returns. Return on equity (ROE) has consistently stayed around the 30% level from 2022 to 2024, while return on assets is in the low to mid-teens. This is a clear sign of an asset-light model delivering high returns with low capital intensity. The balance sheet is another highlight. Leverstyle holds about $34 million in cash at the end of 2024, and the company has virtually zero debt. This means the group is effectively operating in a net cash position, giving it strong financial flexibility for operations, acquisitions, or dividends. Dividends have also been rising. From just 2.5 Hong Kong cents in 2021, management has increased payouts steadily to a total of 13 cents in 2024. This shows a commitment to sharing profits with shareholders as earnings grow. So overall, this 6-year snapshot shows a company that has bounced back strongly from COVID, expanded margins, maintained a clean balance sheet, delivered high returns on equity, and consistently increased dividends. This combination of growth, profitability, and financial discipline is exactly why Leverstyle is increasingly seen as a high-quality, under-the-radar stock. Now let's take a look at Leverstyle's valuation and efficiency snapshot, and you'll immediately see why this company is starting to gain attention. First, the company's market cap has grown meaningfully over the years, from around 220 million Hong Kong dollars in 2020 to nearly 950 million Hong Kong dollars on a trailing basis today. Enterprise value is also low at around 630 million Hong Kong dollars because Leverstyle carries virtually no debt and holds strong net cash. This is important. A low EV relative to revenue and EBITDA often signals potential undervaluation. Next, look at the price-to-book ratio. Back in 2020, the stock traded close to book value. But as the business improved, PB expanded to nearly 2 times on a trailing basis. This tells us the market is starting to recognize the company's stronger profitability and asset-light model. And NAV per share has been rising every single year, showing consistent balance sheet growth. The PE ratio also paints an interesting picture. During COVID, the company was barely profitable, so PE was almost meaningless. But as earnings recovered, the PE fell to attractive levels, around 12 times, then 10 times, and now roughly 6 to 7 times on a trailing basis. That suggests the stock still trades at a discount relative to its earnings power. The next line is one of the biggest highlights: return on invested capital. Leverstyle now generates ROIC above 20%, which is extremely high for a manufacturing-linked business. This proves that the company's asset-light strategy is working, and that every dollar of capital deployed generates strong returns. On enterprise multiples, Leverstyle continues to look very inexpensive. EV/EBITDA is below 4 times on a trailing basis, and EV/sales sits around 0.37. These are levels you normally see in deep value or turnaround stocks, but Leverstyle is neither. It is growing, profitable, and carrying net cash. This combination makes the valuation look even more compelling. So when you put everything together, rising market cap, improving returns, growing NAV, and very low valuation multiples, Leverstyle stands out as a company that is operationally strong, but still undervalued by the market. And that gap between fundamentals and valuation could present long-term upside for investors. Now, let's compare Leverstyle against some of the biggest names in the apparel sourcing and manufacturing industry: Crystal International, Shenzhou International, and PDS Limited. This will give us a clearer picture of how the company stacks up against its peers. First, size and business model. Leverstyle is the smallest player in this group, with a market cap under 1 billion Hong Kong dollars. But unlike the big factories, Lever runs an asset-light platform. It doesn't own large manufacturing plants. Instead, it coordinates a network of over 100 partner factories across Asia. Crystal and Shenzhou, on the other hand, are giant vertically integrated OEMs. They own the factories, the machines, and thousands of workers. PDS is also asset-light, but with much thinner margins. In terms of revenue, Lever is clearly much smaller, around $223 million a year. Crystal does more than 10 times that, and Shenzhou does over 30 times. But here's the interesting part. Lever Style's profitability is surprisingly competitive. Lever's net margin is around 8%, almost exactly the same as Crystal, despite Crystal's massive scale. Shenzhou is the superstar here, with margins above 20%. Meanwhile, PDS, which is supposed to be the closest business model to Lever, runs at a very thin margin below 2%. Lever Style has an ROE of almost 32%, the highest in the entire group. This is a direct benefit of the asset-light model, where capital is not tied up in factories. Crystal and Shenzhou deliver respectable returns, but still far below Lever. And PDS again sits at the bottom, with lower returns despite similar positioning. Now valuation. Lever Style trades at one of the lowest PE multiples, around 7 times earnings. Crystal trades around 12 times. Shenzhou around 15 times, and PDS is extremely expensive, going above 30 to 40 times earnings. Even on EV/EBITDA, Lever is still among the cheapest, roughly 4 times, compared to over 7 times for Crystal and mid-single digits for Shenzhou. Another strength. Lever Style carries almost zero debt and sits comfortably in a net cash position. Crystal has low leverage. Shenzhou is more capital intensive, and PDS carries working capital stress due to its distributor model. So what does this competitor Showdown tell us? Lever Style may be the smallest in scale, but it offers the highest ROE, strong margins, a clean balance sheet, and the lowest valuation multiple in the group. Structurally, it is the only company that combines asset-light flexibility with consistent profitability, and the market is still pricing it at deep value levels compared to the larger OEM giants. Now let's look at the key risks for Lever Style, starting with demand. Because the business depends on US and European fashion brands, any consumer slowdown or recession could cut order volumes. There's also customer quality risk. In 2024 and 2025, management reduced exposure to 2 major clients due to credit issues, showing good discipline, but also how vulnerable the company is if a big customer fails to pay. Next is execution risk. Lever has made several acquisitions and is transforming into a tech-enabled sourcing platform. If integration, digital systems, or AI tools don't deliver efficiencies, costs could rise and margins could slip. And, of course, the Trump tariff risk. New U.S. tariffs on Vietnam and suspected China-linked goods, ranging from 20% to as high as 40%, effectively raise costs for Lever's brand customers. This can lead to delayed orders, lower volumes, or margin pressure. But the picture isn't one-sided. The same chaos also increases demand for flexible, multi-country partners, exactly what Lever specializes in. Early 2025 results already showed higher margins and double-digit profit growth as brands shifted production through Lever's network. So overall, tariffs and customer risk make earnings more volatile. But if Lever continues executing well, the disruptions could actually help it gain market share rather than lose it. So here's the final verdict. Lever Style may be a small cap, but it runs a modern, asset-light sourcing platform with strong margins, high ROE, and almost zero debt, a rare combination in the apparel industry. Valuation is still cheap, profitability is rising, and even conservative targets point to meaningful upside. Yes, the company faces risks, demand uncertainty, customer concentration, execution challenges, and Trump's new tariffs. These can create short-term volatility. But the same volatility is pushing brands to seek flexible, multi-country sourcing partners. And that's exactly where Lever Style shines. In short, Leverage style isn't a guaranteed winner, but it's a genuinely interesting under-the-radar stock with real long-term potential if management continues to execute well. If you enjoyed this deep dive, make sure to hit like, drop a comment, and subscribe to the channel for more high-quality analysis just like this.